Okay, welcome to this meeting. Okay, I'll see if I can hide this thing. So the meeting is being recorded for those who are not here. Um, I'll do a presentation here. Okay, so I'll start off with a bit of introduction. My name is Tom Okore, and I'm going to be your teacher for the Forex trading. So a little bit about Tom Okore. I am a consultant right now based in Lusaka, Zambia, consulting for Comesa. Otherwise, back home in Kenya, I have done many things. So I will save you the agony of trying to remember what I have and what I have not done by giving you maybe my last employer when I was formally employed. I was formally employed by PricewaterhouseCoopers, PwC, and I was supporting their operations in the East Market, where East Market is Kenya, Uganda, Tanzania, Rwanda, um, Zambia, Mauritius. And then, of course, because we were supporting the other offices of PwC, so we supported pretty much the rest of Africa, South Africa, West Africa, even North Africa. So that's when I was employed. But then I went into my own individual consulting. So that's why now I am in Zambia. I was consulting for Lusaka, Zambia. So I am a seasoned management consultant. However, I have taken up Forex trading initially as a hobby, but with time I realized that this thing is actually good and can actually be better than a hobby. So for that reason, I jumped into it. When did I start? I started Forex trading about 3 years ago. And normally people ask, so how are you doing since you started? Well, I wouldn't say I am up there yet, okay? But it has opened up my eyes, and I've been able to make some little money, here and there, but not to where I want to be. And some people are arguing, and I've always been suggesting, why don't you wait and become a millionaire before you can even tell other people? And I said, no, I don't want to be a millionaire first, from Forex, so that I can be able now to tell people, how it is and so on. No, I want to start now when I'm struggling as a Forex trader and share my pain and my success, so that ultimately, when it's inevitable and people can actually see the results of my trading, they can say, yeah, we know where this guy came from. So that's my goal. It is not to wait until I have millions and millions to show around and then show off like many people do online. No, I don't do that. Plus, also, I am determined to actually raise a generation of Africans who can you mute your microphones? Can you mute your microphones? So some people are okay. So please, if you are going to talk, you mute your microphone. Okay. All right. So I've just muted some whoever is there, but yeah, some as they come, some I might not be able to mute. But anyway, I got distracted. So what's my goal with this group? What's my plan with this group? Well, my plan is to share my knowledge. I believe I have learned, but I have learned the hard way. But I'm determined to make sure that everybody else who learns after me should not go through the pain I've gone through. Have I lost money? Yes, a lot of money, a lot of money. So my goal is everybody after me should not lose that kind of money, okay? At least in the quest to learn Forex. So for that reason, I am offering free classes, at least the basics to get you to a point where you can actually, you know what Forex is. You can open a computer, you can download a software program, and you can actually go in and start trading. That's my goal. And maybe teach you a few basic things. Later on, once we have a group of people who now know how to trade, then I will take this to the next level. Okay, where the next level now is to focus more on strategies that I have learned over time, and strategies that I'm willing to share with you. But even some of the more popular used strategies in Forex. So I think we have a quorum now. We have 20 people, 19 now. And so I will go ahead. I'm going to use some slides we've used before. So we hope that you can tag along. All right. So then what is Forex? Oops. Okay. Forex. Forex, in short, is foreign exchange. Foreign exchange. Okay. It is the market where currencies all over the world are traded against each other in the form of pairs. So in simple language, let me try and explain that to you. Right now, I live in Lusaka, Zambia. And so in Lusaka, Zambia, they use kwacha. So in Zambia, when I was working here at Comesa, I was being paid in dollars. Okay. So, but in Zambia, they use something called Zambian kwacha. Now, when I came to Zambia, $1 was about 12.5 kwacha. Oops, sorry. All right. So when I came, the dollar was about $1 equal to 12. Now, 12 kwacha. But over the last several months, something has happened. Okay, because of COVID, because of what's going on in the world, the value of the kwacha has actually gone down to around 18.35 or something, which means that an example is when I came, assuming I wanted to buy something that was maybe $1,000. Let's go for $1,000 again. So if it's $1,000, okay, 7 months ago when I came here, then the price of that same item was about 12,000 kwacha. Okay. Now we are about, I don't know how many, 8 months later, the value of the dollar has remained the same, but the value of the kwacha has, you can say it has gone down. So that now it is $1 equals to 18.35, which means that if I wanted to buy something that was 1,000, so even though I still have the 1,000, or rather, if I had the 1,000 then and converted into kwacha, then I would have 12,000. But now, because of the changes, I would have to pay 18,000 kwacha. Okay, I'd have to pay 6,000 kwachas more for the same item that goes for 1,000 kwacha. Okay, And the same story happens even in Kenya. So I think when I came, $1 was about 100 or 101. Okay, but now the last I checked, unless I'm wrong, is one to is it 105? Okay, the Kenyans can tell us. Yeah. So which means that anything that cost me $1,000 then, okay, now it would be 1,000. Sorry, what am I saying? I'm saying if I was to buy something in Nairobi that was $1, I'd have to pay 100 shillings. But now something that same thing that is $1, I'd have to pay 105 because it has increased. All right. Uh, can you mute your microphone? Mute your microphone. People are still talking. Okay. All right. So, can you guys mute your microphones because I am having a hard time trying to. Unless you are asked to talk, please mute your microphone. All right. So Forex, like we said, is foreign exchange, where foreign exchange is the market where currencies from all over the world are traded against each other in the form of pairs. And so I give you an example of maybe the US dollar and Zambian kwacha. I also give an example of the Kenyan shillings, the US dollar and the Kenyan shilling. When we go to the Forex market, the market has other currencies. I think the popular currencies in Africa that are traded in the Forex market are the South African rand. So, and normally it's denoted by the symbol ZAR. ZAR. So if you go online and you see Euro ZAR, it means it's the pair of the European euro and the South African rand. Okay, but some of the common ones you'll find are Euro USD, Euro USD, and others. Okay, but we will see more about that in the next slide. Okay. All right. So what are the characteristics of the Forex market? It is a market that is open 24 hours, 5 days a week. Why is it 5 days? Because it's closed on Sunday morning till about afternoon in North America. But for the rest of the world, like in Kenya or the East African area, it opens Sunday midnight. Okay? But it's a rare market. It's open 24/7, not 24/7, but 24/5. Which means from Sunday midnight, it is open all the way till Friday midnight. Every day, 24 hours a day. So you can wake up and trade at night. You can wake up at 3 in the morning. You can wake up and trade, anytime, as long as it's within those hours. The other thing about Forex is there are no transactional fees. Okay, but there are other fees that I will explain later on. But basically, they don't charge you to transact, but there's some things they put in the trades that kind of look like transactional fees. Then you're able to buy and sell anytime, whatever the side. In other words, if the market is going up or down, you are able to buy and sell. Usually the market goes up, down, up, down, up, down. So you are able to literally buy, enter, and then sell. It's the only market where you can still make money when you're going up and when you're going down. When you're going up and you're going down. Unlike other markets where you actually can't make money. So Forex market gives you a chance to make money when the market is going up or when it's going down. Okay. So the market is not easily influenced by maybe people or inside trading or somebody knows somebody, and it's very hard to influence it. Why? Because of the amount of money that actually is traded in Forex. The amount of money, I think, for example, you find like the US stock exchange is about $22 billion in a day. That's the US stock exchange. That's a New York, actually, New York Stock Exchange. You find that Europe, London Stock Exchange might be in the same tune of about 25 or 27 billion. Yeah. And then Sydney may be way less, Sydney, Australia. So these are the three centers of Forex. Well, not centers, but the major markets, London and then Sydney for Asian side. Now, you'll find that the Forex market, unlike this other market, trades in a daily, not daily, but a daily basis. Over, I think the last count was $5 trillion. I don't know how you can imagine or you can think about how much a trillion is. So compare the 22 billion of America, 27 of Europe, maybe another 20 or something in Australia. Compare that, and this, I think these ones are actually monthly, not even a day. The Forex market does this in one day. In one day. Which means that it's not easy to influence that kind of currency, even if the Americans wanted. Okay? It has significant leverage. Leverage means that you don't have to have billions or a lot of money to trade Forex. In fact, in some brokers, you can trade with as little as $1 or 5 or 20 or 50 or 100, whereas others are doing billions, I mean billions of dollars. So your $1, depending on which broker you're using, can allow you maybe to trade $1,000. That's what we call leverage. Leverage means that you don't have to have a lot of money to trade. Okay, I think for those of you who studied physics, if this is a fulcrum, then we are saying that for $1 you can trade like $1,000. That is what we call leverage. It's like saying a little baby here, if a little baby sat on this thing here, the little baby can probably lift like 10 people or something. This thing is long enough. This thing is long enough. You can have a big person, there. So this baby can actually lift this person up by sitting down on this thing. That's the idea of leverage. So a lot of your currencies you use is going to be little, but it allow you to trade a lot of stuff. Then it has a lot of liquidity. The liquidity is what we said. We have $5 trillion to trade. You know, $5 trillion. Then there's a lot of free information online. A lot of free information to know which traders, which brokers, what's going on, what to do. Sometimes people even argue that there is over information. There's too much information, which can become confusing. And that's why people like us have come in to help for free. So, of course, I've mentioned the low initial deposit. Okay. All right. So we'll go to the next slide. The currency pair. The currency pair is a combination of two currencies, with the first being the base currency and the second being the quote currency. So, for example, Euro USD. This Euro itself is the base currency, okay, and the USD is the quote currency. Do you need to memorize that? No, you don't need to. Okay, all you need to know is the combination is called a forex pair. So when you'll be trading, you'll be looking for the currencies. So, and especially the currencies that move a lot. So you'll be trying to find out what's moving a lot in the market so that you can then go in and trade. Because it's the movement of up and down that people make money. All right. So you can get into the market when the value of Euro USD maybe is at 1.3521. Okay. But you actually trade up to somewhere there, and there it's 1.352, maybe 9. So right there, you have made, if you subtract this from that, you have made what you call 8. But it's given a name, it's called pips. Okay? You'll get to know the meaning of pips later, but it's just a unit that has been set up for you to be able to see what, in terms of going up and down, what you're making, So the unit of the exchange or change of currency from one level to the next level is called a pip. All right. And so we will talk more about that. So if you buy a currency pair, you're buying the base currency and you're selling the quote currency. So if I'm buying Euro USD, so Euro USD is going up, so I go in and actually buy. If you're buying, essentially what you're saying is you are buying the base currency. You're buying euros. Okay? You're buying euros, but you're also selling USD. Okay? Then there's what we call the ask price for the currency. Represents how much you will get in quote currency for selling the base currency. Now, don't worry about that terminology, at least at this level. You'll get to know more about it later. Okay. So, tradable instruments. Well, Forex allows what we call commodities. Okay.
Hello, Mr. Tom.
Yes. Yes.
Kindly go back the something I was writing.
There's something you're writing. No, we are recording this,
Yes.
so maybe we will share with you this. Is that okay?
Okay.
Yeah. We will share this later because actually there's a recording going on. Sawa. Okay, so after the meeting, I will share the recording. All right. So these are tradable instruments, and the instruments are gold, silver, oil, wheat, soy, coffee, all these people, and on the indices like Nikkei, SP 500, Eurostox, DAX, FTSE, and so on. All those are tradable instruments, which means if you go into Forex, okay, not Forex, but actually online, you might find all this being traded. They're all being traded. Okay, but for us, we'll only focus on foreign exchange. Okay, foreign exchange. So sorry. All right. So the currencies that we look at usually are as follows. These are called the majors. The majors are the more popular ones, for lack of a better word, popular, but the most liquid currencies in the world. That means they're used a lot. Okay? The euro, the USD, the Great British pound, Australian dollar, Canadian dollar, Japanese yen, Swiss franc, New Zealand dollar, Australian dollar. These are just a few, but these are called the majors. Why? Because they're very popular with people. People like to buy them when they're traveling. If you're traveling from here to London or other countries, it's more than likely that actually you will buy US dollars. If you're going to buy your ticket to fly to Europe, they'll probably quote it for you in USD. Okay? In some countries, they would, like if in Europe, they're more likely to quote it in euros. You have to pay them in euros. But most of Africa, for some reason, we are stuck with USD. More countries prefer to use the USD. So those are the main major currencies. Okay. So then there's what we call major crosses, which means some currencies are paired up. They're not very, very popular, but they are also used for trading. For example, uh, the Great British Pound with Swiss francs, the Australian dollar with the Swiss franc, GBP Canadian dollar, GBP New Zealand dollar. Others will be Australian dollar, Swiss franc. Okay, uh, these are cross currencies. They are not the major ones, but they're called cross currencies. So these are the major ones there. This JPY is Japanese yen. Okay, Japanese yen. You'll get a chance to look at them more and trade them also. So there's also what we call exotic pairs, where exotic pairs are pairs that are not always traded, okay, but they're there. They're not as popular as the other ones. For example, I mentioned South African rand. Okay? South African rand, look here. Okay, so if you see this USD ZAR is South African rand. Okay? There's also the Mexican peso. Okay, the Swedish krona, or this Denmark krona, Swedish Norwegian krona. Those are what we call exotic pairs. They are not traded much. However, they trade in the forex market exchange. All right. Most traded pair in the world is the Euro USD. Most people in the world prefer to trade the Euro USD. Why? Because by themselves they are very popular. The currencies there are very, very popular. So you find that here in Zambia, you use a lot of dollars. Okay? I know in Nairobi we use dollars too. Sometimes the people use euros. Even here, sometimes use euros, but the dollar is most popular. So of course, the next popular currency is the euro. Okay? And then the Great British Pound and Japanese yen. Okay? So any combination that has USD is more likely to be very volatile. Like, it moves a lot like that because people are buying and selling, buying and selling, buying and selling. Now, a classic example: countries, most African countries, import like maybe electronics, or we buy things that we don't manufacture, in our countries, like vehicles and so on. So if you're going to buy a vehicle from Japan or from the UK or even from South Africa, you are more likely to be given a quote in US dollar. In US dollar. If you're going to import your own car, you probably pay in US dollar. If you're going to import maybe a container of electronics, they're going to charge you in US dollar. So because of the high use of the currencies, then you find that the pair, like Euro USD, moves a lot. Moves a lot. Unlike other pairs that go like that, they don't move much. Okay? But US dollar is like that. Okay? So, and I will explain that movement later. All right. The major players in Forex. So, who are the major players in Forex? The major players in Forex are what we call institutions. Okay? The institutions, for example, what we have here, the institutions are like commercial banks, okay, 43%. Then the central banks, institutional investors, multinational corporations, and then retailers. The retailers are like the me and you, okay? Me and you. We are the retail traders in Forex. So who are these people? Who are the commercial banks? The commercial banks are the banks that move millions and billions of dollars every day. Like we all know Barclays Bank, we know HSBC, we know the Standard Chartered, we know the Citibank, okay, Citibank, etc. So all these banks, commercial banks, move large amounts of money. Why? Because in their respective countries, the business people come and transact through them. Okay. So, for example, a car dealer in Lusaka wants to import maybe 10 vehicles for their dealership. Okay. So they have to look for a reputable bank. So what they need, they have to, if one vehicle is about maybe $30,000.
Can we have Mary Uma mute? Mary Uma, please mute. There's a lot of noise.
Yeah, you can advise her.
Thank you.
If she's able to hear us.
Thank you. So, Mary Auma, please mute your microphone. So I was giving an example of maybe an auto dealership in Lusaka who wants to import 10 vehicles, okay, from Japan. And these are maybe regular vehicles or maybe high-end vehicles. And each vehicle is about $30,000. Now, if each vehicle is $30,000 and he wants 10, means he has to look for $300,000. Now he goes to his bank, local banks, okay, but because the local bank, or maybe he has another account, a dollar account. This bank will have to request maybe through a big bank like Barclays or Standard and so on, okay, to take his $300,000 and pay a dealer in Japan. Okay, so he goes there and says, Barclays, please take my money in my account and ship it or send it to this person in Japan. Okay, so electronically it's done. All right. Then some people are okay. Maybe the country, Zambia, maybe is exporting some copper. Okay, and this copper maybe even Japan wants to buy the copper from Zambia, and because they are a big country, they're going to buy tons, maybe like 10,000 tons of copper, and one ton maybe might be maybe 100,000. So I'm just telling you millions. So Japan, the company in Japan will transfer millions. Will tell their bank, maybe their bank is HBC, HSBC. HSBC will prepare maybe $100 million and transfer to Zambia, maybe to a local bank here, maybe Stanbic Bank and so on. So you see, these commercial banks are used for moving money up, left and right, to Japan and back and so on. So because of that, these are the biggest movers of markets. So that's why in the morning, it's called London Breakout. If you look at the markets at night there's not much movement because it's only Asian market. But as it goes like that, then in the morning, just before London market starts opening, suddenly something starts happening. It starts moving, moving very fast. Okay? But before, the whole night was just going, a very small range. The reason for this is these transactions from the big banks. Okay? So the big banks are the big players in the Forex, and they actually account for 43%. Then institutional investors account for 30% of the movement. So who are these investors? Is pension funds, hedge funds, insurance companies, etc., etc., etc. They also move a lot of money. Why? Because the people who have put money in them have asked them to invest. Okay? Pension funds. People, when they work, they put some money in pension funds, hoping that when they retire, they would have more money. So these guys take your small money every day, enter into an account, and then your big bank trades with that money. Okay? So they push lots of money. So pension funds will have collected a lot of money here, and maybe Barclays Bank, maybe they keep the money in Barclays Bank. So there is a lot of money that's sitting there doing nothing, but Barclays Bank must trade it because eventually you have to give these guys their money plus profit. That's why they move the market. Hedge funds, the same thing. Insurance companies, the same thing. Okay? They have to make that money move to have money for you. Then there's also the multinational corporations. Those are the third group of people that move billions in the market. So, for example, Apple. If Apple wants to release a new phone, okay, and the phones are being manufactured right now in China, they have to pay the manufacturers in China a lot of money. Maybe for the new iPhone 10X, they want more new units. They might have to transfer billions, and they do that through their direct accounts. Okay, so they'll have to probably go to the bank, or they themselves send money from their bank to Volkswagen China. So because of that, they then move the market. And then there is a small person. The small person now is you and me. For us who want to go into the market and get our small money and come out. So 2%. But let that not deceive you. 2% of $5 trillion. Okay, I don't even know how many. This is, that's 5 million. That's billion. I think that is trillion, eh? All right. Anyway, I don't know. It looks like trillion. So 2% of this is what's 2% of that? Divided by 2.5. So it's about 25 or 250 billion. Yeah. Retail traders are moving that kind of money in a day. All right. Next, pips. We're back to the technical terms. So I tried to explain earlier what a pip is. So the Euro USD, so I know that the Euro USD right now currently, Euro USD, about 1.3, maybe 5. Okay. If it was to decrease, it would be 1.35, maybe 1.5, and the difference would be 10. Okay? We don't say 0.00 blah 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 blah. No, the difference is 10, and we call that 10 pips. Okay. So when you go to the market every day, you're looking for pips. Please note that this number is higher than this one. Okay, which means if you're trading, so if this is X and this is Y, your X, if the market is going up, your X, okay, would be this small number, and your Y would be the big number. And the pips, you'll have made the pips when you are buying. Now, buying in Forex is also called bullish. Bullish. All right. And also called long. If you're going long in a market, then you're saying you're buying. Now, selling is the same idea, only this time we switch the numbers. We're going down. Okay, so here we have this same number here, the Y, and here we have X. So we're coming from this high number to that low number. So if you're coming down, we say we are selling, which is bearish. We say bearish in the market, bear, like the animal bear. Bear. And we're actually saying we are going short. So if you hear somebody saying, "Oh, I'm short on a particular currency," it means they're selling. Okay. If someone says, "Oh, I'm long," then you know they are buying. If I say I'm bearish, it means I am selling. If I'm bullish, it means I'm buying. All right. So that's the terminology you'll get to get used to it. Bid and ask price. I think in the next slide. Oh, here it is. Okay. So the bid price is what the dealer is willing to pay for a currency. Okay. And the ask price is the rate at which some of the dealers will sell the same currency. This is what you're willing to pay, and this is what you sell, the same currency. All right. So with time, you'll get to know more. You'll get to know more about the differences and so on. Leverage, we mentioned about that. Drawdown. The drawdown, a market can be going like that, like that, and then suddenly, because of news, and then it suddenly goes down. Usually what would happen is, if maybe you are trading and maybe you're up 10 or 15 or 50 pips, okay, in your account, then suddenly, also, sorry, this is positive, not, okay, then suddenly the market goes down and you find yourself at minus 200 pips. We say you just experienced a serious drawdown. Drawdown is when the market just goes against you and you lose a lot. Usually what will happen is your account may suddenly lose a lot of money all of a sudden. That's called a drawdown. Then in Forex, there are two kinds of analysis. There's what we call the fundamental analysis, and then there's technical analysis. Fundamental analysis is what I was just trying to explain here. Sometimes when there's news happening, especially these last few days during COVID, okay, or during the riots, demonstrations in the US, sometimes those kinds of things can cause a drawdown. Okay? Then there is also what we call scheduled news. Scheduled, where maybe the head of the U.S. Federal Bank will be giving maybe a report on their current situation, financial situation. And normally these are scheduled almost on a monthly basis, and you'll get to know them. Some of them are called like payroll, non-farm payroll. So whenever there are news scheduled by the government, they do affect the currencies, the volatility in the market. And those are what we call fundamental analysis. So there are people who they specialize in trading only fundamental analysis. But that's their strategy. They like the idea of seeing the news and they know something will happen. Now, I have to confess, initially I thought that was kind of cool because I like business news. I've always liked business news. So I used to put at the background, there's a channel called Bloomberg. For those of you who have Bloomberg. It's actually a TV channel, but mostly business, but in particular, financial. Okay? 24/7. So I used to have this always at the background at home, so that I would have my Forex I'm trading, and when there's news, I listen, because sometimes they might say, oh, maybe Apple has shut down a particular factory or has opened what and what, and immediately you know what will happen. It will affect what's going on in the market. Maybe like now with the riots in the US, the currency, the US currency is really being hit, hammered. And because of those uncertain times, people now are flying away, getting away from the US dollar. It's not a safe haven anymore. They are actually getting away to the other more stable currencies. So when things are not going very well in the US, people are getting away from there and now using the other currencies that they think are more stable. Okay, so in this case, there's a big flight from US to the euro. Now, with the mess going on in the euro, people are now confused because euro also has its own issues. They have Brexit. Okay, so they're going back and forth. When things are pretty bad in the US, they move their currencies to the euro. When the euro is getting in trouble, they move back. You know, so people are now almost thinking the safe currencies, things like the Swiss francs and so on, are now becoming newer safe havens. Okay? But in the meantime, it's still the euro, the euro and the USD, so the most stable currencies. So fundamental news, done that. Technical analysis. Technical analysis is basically the kind of analysis that requires you to know what is happening in terms of the market. If you look at the market, okay, and the market normally goes up and down. So a technical analyst will look at this and will say, this is an uptrend. Okay, but if you ask them why, they will argue that, well, because this is a low and this is a high, but this is higher low and this is a higher high, and this is a higher low and this is a higher high. So the continuous higher highs and higher lows, higher highs and higher lows is an indicator that we have a trend. Okay. Now, a technical analyst will look at the chart, and the chart will be going up and down, seems to be bouncing between two areas. Okay? And an analyst will say this market is ranging. It's within a range. A range means goes to a particular low, goes to a particular high, a particular low to a particular high. All right. And similarly, if it starts going going low and then high, and then low and then high, and then low and then high, and so on, okay, then the technical analyst will tell you that the market is on a downtrend. On a downtrend. Now, if you look properly, the downtrend consists of a high, lower high, a high, a lower high, a high, sorry, a lower high, sorry. These are the highs, and these are the lows. So let's call these ones the highs, and these ones the lows. So here, because these are highs, this first one is a lower high, and this is a lower low. Sorry, a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Okay, that would be what a technical analyst will tell you. Now, there are also patterns that form. Okay, so the patterns that form are very many, but I'll just show you a few. If the Forex is going like that, okay, the market is going like that, what do you see? What do you notice? You notice something interesting. You notice that there seems to be something up there blocking this currency. But at the same time, there seems to be a continuous, almost uniformly, forms like a wedge. It means that in terms of what I call fundamentals, there's pressure from the buyers, because buyers are putting pressure for this price to go up. to go and actually pass that point X, line X. Okay, so there's pressure. Every time the sellers pull down, the buyers push up. Pull down a little bit, the buyers push up. And this pressure increases until a point where now it can't take it anymore and it bursts. So an analyst, technical analyst, will tell you that a wedge is forming, and at this price, you will see a breakout. So for you as a trader, that's like a heads up. It's like time to get ready, because if you see this pattern, something is happening. There's pressure on the upward, which means if it hits that point X, this price will go up. And what you want to do is you want to put your trades ready. Sometimes they call them pending orders. You can put your trade ready to go. Okay. Oops. So you
Is there?
Huh?
Hello?
Yes, go ahead. Question?
Is there a way for a breakout down?
Yes, there's possibility also. Even this one, there's no guarantee that it's always going to be up. So for now, I'm just trying to explain that this is an opportunity for you to get ready for a breakout. And from the way it's going right now, if it was coming from down here, it's more than likely it will break up. Now, in some cases, if it was coming from down, from up, coming down, it might actually continue. Downwards. Downwards like that. Okay, it was coming from up, and then consolidation, and then it breaks out. Now, you don't know if it's gonna go up or down. That's where in Forex you can have a strategy which we'll get into one day, where you put pending orders, because you don't know where it's going to go, up or down. You put pending orders on this currency. So the pending orders could be there and there. So you're saying if the currency breaks out, or you can even put a few pips out of that, and a few up there. So if the market goes down, you want it to get you into a trade at that point. Okay? So it will trigger your trade. So you want it to go down with you. Or if it chose to go up, it triggers your trade here and it goes up with you. Which is why trading Forex can be very easy if you know what strategies to put. So each of these can be looked at as a breakout strategy. Okay? But one of the strategies, I don't even know how it's called, but if you do a setup here and a setup there, you are more like a sniper. You are not chasing the market. You're saying, let the market come to me. Why? Because you know this thing is consolidating, and very soon it will break out. So for you, you're saying, I don't care whether it goes up or it goes down. What I want to do is, whichever side it goes, I want to go in and make some money. So you want to make 10 pips. So the 10 pip, you will get them because this market will break out up or down. You don't care where. But if it's going to go up, you trigger your trade there, and you get your 10 pips. Or if you chose to go down, you trigger your trade there, goes down, get your 10 pips, and then you're out. Okay? So that's more like almost like a sure way of trading. And that's why the biggest time people like to trade is the openings of the market, especially the London market. The London market opens up with a bang because the whole night the market has been quiet. Well, not quiet, but the Asian session has been very quiet. And then in the morning, so if you look at the charts, usually at night, they don't move very much. And then You look at, if this is 9 a.m. or 8:30 in the morning, London time. Okay, so if you are watching this trade, that's the lowest point it reached the whole night, and this is the highest point it reached the whole night. Okay, the strategy that tells you how far back you want to look. You want to look like the last 8 hours. Okay, you look at the lowest and the highest, and you know that when London happens, it will pass. It will break those points. So from 8:30, you'll start seeing activity. Okay, maybe it'll go like that to try and revisit the low there, and then it might maybe go there a little bit and fake people, and then come back, go like that, and then maybe break off, and then now it's big. See, so if you look at this compared to that, the price cycle, look for the price cycle, you find that after the London breakout, the price cycles become bigger. But before the price cycle, before London breakout, the price cycles are very small. Occasionally, here and there. But people make money when these things break out like that or break out down. Okay, and we'll talk more about that. So, technical analysis is just a way of looking at the charts and understanding what's going on and making your strategies or your plans based on what you see. All right. Economic indicators, I think I kind of alluded to that earlier. The indicators are normally what the banks of the central banks of the countries that move the markets, the kind of decisions they make. For example, the farm, like in America, we have jobs that are run by farmers. Okay? Sometimes when the economy improves, there's more jobs in the economy. And when there's more jobs in the economy, payroll increases. So when payroll increases, you might find that that's an injection of maybe $1 billion in the economy in a month. That's a lot of money. So in the US and some of the developed countries, they are mandated by the government to report every time they hire somebody. Okay, a non-farm job, an office job, or a clerk, or messenger, whatever. Anybody who gets payroll, as long as you get payroll, the company or the organization must report, which means they keep track of that because that has an effect on the money, the currencies. Okay? So in economic indicators, you can read more about them, but I'm just telling you that yes, when they do read, like when they're having the news, normally they talk about these economic indicators. So if you are a fundamental trader, you'll be very interested in the economic indicators. I had a friend who he has a very good memory. I mean, not like me. I guess he can memorize things. And he has memorized all those economic indicators, like the news. He calls this farm payroll, this what, all those. He knows them, and he knows when they are being announced. So he doesn't trade anytime. He just waits for those news because he's a fundamental trader. So sometimes you read those indicators and they can be very interesting. When they say, like now, because of the serious job losses in the world, okay? But let's take, for example, America, then the payrolls have gone down, okay? The payrolls have gone down and people are running away. There's less liquidity, there's less money in people's pockets. So that has an effect on the other currencies, on the pairs that it has. So if you are an economic indicator kind of person, who you like news and all the stuff, then you are a very good fundamental analyst. Because when those things go down like that, you quickly go in and do your buying and so on, because you know the effect, the net effect. Now, I have to explain this at this point because every time we talk about currencies, people ask me, so how does the currency go up and down? What causes it? Yes, we know it's fundamental analysis, fundamental news, what's going on, but essentially, and let the non-mathematicians don't get scared. So if I have two numbers, x over y, okay, this is a fraction. So assuming we have a fraction, and then if I reduce, sorry, if y loses value, what happens to the fraction? Will the fraction increase or decrease? If y loses value, okay? If y loses value, for example, if this is 10 over 10, 10 over 10 equals 1, right? If y loses value and becomes 5, okay, what happens to the fraction? Shoots up, right? Why? Because 10 divided by 5 equals 2. When it was 10 out of 10, we had 1. But when it's 10 out of over 5, becomes 2, all right? When it's 10 over, let's say, y keeps going down. It was 10, then things are bad, moves down to 5, things are bad, moves down to 2. That's the y value. When it is 2, what is 10 divided by 2? 10 divided by 2 is 5. So if you're drawing a graph of this xy, okay, you'll find that now it's actually way up there. So when this pair of currency, x over y, when the bottom one is being affected, then the currency pair goes up. So, classic example, if you get now euro, USD, euro, USD. Basically, what it means euro divided by the dollar, USD. Oops. So here, if the dollar is losing value very quickly, what happens to the pair? The euro USD will be climbing. Why? Assuming all things are constant, okay? With a decrease in the value of the USD, the ratio euro USD will increase. And that's why you find that the last couple of days, on the daily charts, the euro USD has actually been going up. And people are wondering, how far up will it go? Well, it's going up because the euro is almost constant, but the USD is losing value very fast, okay, in the US because of what's going on. And so this will keep going up, all right? And the converse is true. In other words, if we hold y constant and increase x or reduce x, let's now reduce x, okay? So assuming the US is stable, and a few months ago, the euro was very unstable, okay? We were actually getting to a point where, because of Brexit and so on and so on, so the euro was going down, okay? What is the net effect on that ratio? So if this is 10 over 10, okay, and now we are saying, instead of 10 over 10, we are saying, so 10 over 10 equals to 1. And we want the top to keep going down. So it becomes 9 over 10. 9 over 10 is 0.9. 9. 7 over 10. 7 over 10, 0.7. So it actually goes down. So keep the Y constant, and the euro goes down. If there is instability in Europe, this will go down. If it goes down, the ratio will go down. So if you look at the euro USD currency around Brexit time, you'll find that the currency was actually going down. Why? Because the euro was losing its value. People are not confident of the euro and they're moving to the other currencies. All right. So those are the dynamics that if you hear the news and what's going on, you can basically understand why the currencies are moving up, down, okay? And really exactly what is happening. What is happening is the value of that currency is going down. But because it is a ratio, the ratio increases or decreases depending on what's going on. Okay? Now, I know I've gone a little in depth with that, but I've had that question several times, and I thought I should just share with you that. All right. We should be finishing this shortly and move on to a bit more nice stuff. So we've talked about that. Margin call, you'll read about that when you start trading, but I'll skip it just because of time. Let me see what I need to share here. We've basically done all this. Volume is just the amount of currency money going in. Swap, if you keep your trades overnight, you'll be charged some money, and it's called a swap. Okay, long, short. Whipsaw is the same thing, like the drawdown. The whipsaw can be suddenly the currency is moving, then goes down, and then starts going back. That's called a whipsaw. Volatility is actually the moving up and down, up and down, up and down, and so on. Margin call means that you don't have any more credit or balance into your account. If you had $1,000 and you are trading very huge lots and you're not watching your risk, then something like this happens in your market, you find that your 1,000 is wiped out completely. Okay, and then your account is blocked because now you don't have any money. Okay, and often they call that a margin call. Okay, you are on a margin call. Okay, but some of these things you'll have to experience them on a demo for you to understand what's going on. So right now it's like speaking Greek to you, but hopefully it will help. All right. Sorry, that took a little long, but we're learning. So, major trading sessions. The major trading sessions are three major trading sessions. They are the Asian market, okay, which is from Kenyan time. It's 12 a.m. to 11 a.m. in the morning. All right. Basically, just at night. And then the European session is 9 a.m. to about 6 p.m. All right, and then there's a New York session, which is 4:30 p.m. to 12 a.m. Now, this is Kenya time, East African time. In Zambia, just add 1 hour. Subtract 1 hour in each of those. All right. So, what's the Asian session? Well, the Asian session is when, see, the world, in the days they used to draw the world, something like that. If you were to open the world, it would be something like that, where the North Americas, and then there's Africa, and then there is Asia, Europe and Asia, and then Asia, and there's Australia somewhere there. So if you take the world and then you divide it into parts, okay? So America, from GMT, let's say GMT is somewhere here. You all know about GMT. It's actually more on the left, but anyway. So America session, to them, when it's daytime here, it's nighttime on the other side. So, well, assume this is the world anyway. I was just going to say that when it is daytime in America, it's more likely nighttime in Africa. Okay, so that's America. Then so in Forex, this you can call this the New York session, okay, or the American session, and then this is the European session. Oops. And then this is the Asian session. Okay. So the Asian session means that the Australians, the Singapore, and Japanese, Tokyo, those guys, when they are awake trading, these guys are asleep. Most of Europe and New York is asleep. So the Forex market goes with the times during the day. So you find that if we were to start, we start maybe with New York. New York opens up, and while we're trading, the New York market for lack of a better word, interludes, or when it's still on, the other session, the European session, begins. Okay. Again, I'm just giving an example. Just look at the example. Don't worry about the details yet. And then when this is going on, the middle one is going on. Okay. This one ends. So this one is on, and when it's on, it also interfaces with the other one. All right. So the Asian session is normally considered the slowest because in Asia, apart from Tokyo and Sydney, there might be a few other centers, okay? But the liquidity that's moving there is nothing compared to maybe New York or Europe. However, during certain times, you find that there's a rollover between maybe Europe and Asia. So in around that time, there's a lot of volatility. Okay, and the same thing when the rollover between Europe and America, there's a lot of volatility. So this happens at 12 midnight, maybe around 8 a.m. for European market, and New York around 4:30 p.m. So during that time, like in New York, you'll find that the European market is still on, but about to close, and New York is opening. For Europe, it interfaces the New York and the Asian market. Early in the morning, the Asian market is still on. It's still on, while the European market is opening. Then later on, the European market shuts down, New York opens. When the New York opens, European has shut down. But when the New York opens, it stays long enough for the Asian market to also open from the other side. So, the world goes round and round and round and round. So that is the world trading session. So the trading sessions are, if you want to trade the Asian session, you have to stick around or stay around at night. European sessions, those are the times, and New York, the times. Now, if you want the time with the highest volatility, is usually European Open. European Open. That's called the London Open. So the market starts moving around 8:30 because if you look at Europe, there's on the left-hand side there's Ireland, there's London, there's what. Okay, then as you start crossing over to Europe, you come to the Middle European countries. So they do have like an hour or two spread from the time the first banks open in Ireland, the time the last banks open, maybe in the other end of Europe. Yeah. So there's spread over there. And so that time, with the interface with Asia, there's a lot of liquidity and people can make a lot of money there. The other best time is the interface between European and New York time. Because at that time, the New York market is opening and the European markets are closing. And so there's a lot of volatility and you can make a lot of money because of high volatility. Okay? So the issue is volatility. When there's volatility, you're likely to make a lot of money. Especially if you are a short-term trader. If you're a long-term trader, you'd care less about that. All right? Need to move on quickly. So I will share these notes with you. So these are just notes, just explaining what I've just talked about right now. Right? The Sydney and Asian Tokyo session, European session. Right? So like I said, this is the most volatile. And the reason why, I think I just need to highlight that. Okay. So 2 major trading sessions. Okay, with the London being such a key financial center. Okay. A large chunk of Forex transactions take place during this time, leads to higher liquidity and potentially lower transactional costs, lower pips spreads. These are something we need to learn later on. The pip spreads, the spread between, when you enter into a trade to the actual place it enters. So it has large amount of transactions and high volatility. Okay. So trends can sometimes reverse at the end of the session. So you might find that in the morning, it might start and go, very, very fast. Towards the end of the London session, you see that now they're losing volatility, and then New York comes, and then it goes down, and then so you see that change, like shifting gears now. We were going up, and then the European session ends, and now we start the American session. Okay? So sometimes, not all the time, but usually the change of sessions from Asia to Europe, usually there's a change again, and then from Europe to America there's a change. But the market changes several times in a particular session. So it's not the only time. All right. New York session, we'll read about that. So I think I need to jump into the charts because many of you are waiting to get in the charts. Okay. But all this you will read. Okay. Unfortunately, we don't have enough time. We normally have just a few hours in an evening. So for these notes, I will share them with you and maybe even the recording for those of you who want the recording. Then the next few things here were just about the platform, MetaTrader 4 and 5, which are similar. Introduction, how it looks like. So that one you will have also. You have it in your. I'm recording it. So, yep. But I also sent you videos today in the group. Videos about MetaTrader and how to trade with MetaTrader. So the good thing about the videos is if you start from the beginning, it gives you the ABCs of the platform, okay? And then it tells you how to enter your trades and how to use all those indicators they have, and then eventually, maybe they don't talk so much about the strategies, but strategies we'll talk about in this forum. Now, why do I give you all this information? I give it to you so you can read, and learn. Forex is not about you sitting down and waiting for somebody to do it for you. It's about you reading, learning how to trade, and then going in and trading yourself. That's the beauty of it. Okay? So mine is just to guide you more like a coach, but eventually you're the one to play the game. The game has to be played by you. For me, mine is just to guide you on the initial stuff, It's like feeding a small baby. You have to feed the person, small baby, like milk for a while, and then when they're able to drink some porridge, then eventually eat some meat, and that's what I'll be doing. So for now, I will jump to the charts so that we can look at the charts for the remainder of the time. Now, any question? Because I think I've been not allowing you to ask questions. Any questions up to now? This is when you can open your.
I have a question.
Say your name and where you're.
Yes.
Yeah.
Yes, I'm Dennis Otieno. I'm from Kenya.
All right, Dennis.
So you find that in Forex, like when there's a lot of volatility, people make money.
Make money, yes.
In terms, we call it profit. And we know that whenever you make money, this money, it comes from somewhere. So does it mean that like when you get profit, somebody else has made a loss?
Yeah, absolutely. Absolutely. Yeah. Okay. That's an interesting question, but let me try and see if I can explain. It's actually a very complex thing that goes on around. Trying to look for less busy chat. Okay. So this is a good market. It's actually moving a lot, all right? And let's assume we were here at point X. Okay, so pretend everything on the right hand side was not there. Okay, and you knew that this market will start going up. Hence, people start buying. Actually, this is what happens. The commercial banks will, at this point, okay, throw in money into the market. They've thrown in a lot of money in the market. Okay, at this point, they were selling. Then suddenly, because they were selling, they've sold everything they need, everything they had to sell. Then, as they're selling, there are people who actually want that money, and they will start buying. They will start buying. They will buy. Then at that point, the buyers are saying, okay, we bought enough. Then the sellers start selling. So it's a push of buy and sell, buy and sell, buy and sell. So as the people who are selling money, the buyers are now being pushed back. They cannot buy as much as they want. Okay? But then they come back, they start buying. As they buy, the sellers push down a little bit. Then the buyers. So it's always a push down and a push up. Okay? Between buyers and sellers. Now, when the sellers are pushing down, if they are selling, they are making money. If the buyers are going up, okay, if they are overcoming the sellers, then the buyers are making money, and these guys are losing money. So there's somebody who is losing, there's somebody who is making money. So at this point, the buyers who are here, if you are a buyer, you will be making money. But if you thought this market is going down and you are still here and you are doing a sell, what happens to you? You are doing a sell, but the market is going up, which means as it goes up, you are losing. You are losing until up there. When you get there, if you're a buyer and you still think, oh, this thing is still going up, okay? So you are on a buy, but now the market has changed, it's going down. So if it's going down and you are actually buying, the more it goes down, the more you lose. The more you lose. So there's an equal and whatever in physics they used to call an equal and parallel force. If this guy is buying, sorry, this guy is selling, this guy must be buying. Why? There must be something for him there. The buyer must have something to buy, and he can only get something to buy if the seller is willing to sell. So you can't have the market going up if there are no people selling down. So I don't know if I've answered your question, but every time there are buyers, then there are equal measure of sellers. So there are those who will be making money on a buy, there are those who will be losing money on a sell. So like sometimes you think this will be going up forever. So you reach here and you decide you want to continue buying, continue on a buy. And we've done that several times, most of us. So after this red candle, you press buy. But when you press buy, the market now is going behind you, opposite your direction. What happens to your trade? You start going negative, negative, negative. Why? Because you're trying to go up, and these guys are going down. And that's how you lose money. So I don't know if I've answered your question, but yes, when you're making money, others are losing. When they're losing money, others are making money. Sorry, that was a long answer to your question. Yes.
Especially with the last example you've given, I've got it very clearly because I've seen sometimes you find our figures are negative, which means you are losing.
Yes.
And sometimes it is green, which means you are gaining.
Yes.
So it's clear. Thank you.
Okay, thank you. All right. Any other question?
Hi, Tom.
Yeah, hi, Mark. Say your name and
Yeah,
where you're
now,
from. Sorry.
sorry. Yeah, I wanted to know
But you have to say where you're from.
whether in terms of Forex, can you hear me well?
Yeah, I can hear you. Where
Yeah,
is
in terms of Forex, is it just trading, but in terms of institutional investors, are they also just buying to make profit, or some of the institutions are buying, let's say, other currencies to do some trade, to buy equipment or build something,
all that? There are other institutions that are okay. Institutions buy stuff for use, like Apple or Caterpillar. Caterpillar in Africa, you probably need to buy Caterpillar's tractors to come to Africa and make roads. You see, so the company Caterpillar will probably be buying their machines from somewhere, or whoever it is here will be buying. So as they buy, they need the currency to transact. So where do they get the currency? They get it from the bank. So these institutions use the money. Okay, that movement of money from maybe Africa now to Europe, because now we need the machines from Caterpillar, or Asia. Okay, the movement of money from Africa to Asia causes the movement of the market. Okay, of course they go through the banks, but also the banks also trade, because they have the pension funds, they have the hedge funds, they have insurance companies. The insurance companies keep their money in the same banks. Okay, maybe at Barclays Bank, Standard Chartered, or Citibank. So you find that insurance companies don't spend their money a lot, but what they do, they take like maybe 100 million and move it to the bank today. Maybe tomorrow they have to pay out 10 million. Then they move a little bit. Then they have more. So the movement of money in and out of the banks, and the banks by extension to the big central banks. Okay, so central banks would say, okay, now tomorrow we need, at night, we need maybe $20 billion. $20 billion. All right, so that means tomorrow we have to go to the Forex exchange and get $20 billion, just the exchange. But because we are exchanging Kenya shillings to dollars, we know we shall be losing some money. because we have to pay in Kenya shillings to get the dollars. So the movement of money up and down, whether it's through the banks or the institutions, causes the volatility, and that is what people are trading.
Okay, thank you.
All right. Oh,
Yes, hello.
yes.
Hello.
Yes, hello.
Yeah, I'm called William Olega.
Yes, William.
I'm calling from Zambia.
Zambia. Yes, William.
Okay, I've been having challenge in regards. Okay, when is the best time to enter trade and when is the best time to exit trade? What are the indicators that one has to watch out for to see that, okay, this is the trade that I need to end, this is the moment I need to enter? That way it will have to get some guide, some kind of guide.
Okay. All right. You've asked two questions: best time to enter trades, and what are the indicators to use to guide you? All right. The answer to that, depending on who you're talking to, if they are a professional trader, they will tell you any time is the best time. Any time is the best time.
Okay.
And any trade is any indicator is a good indicator. The only difference is it depends on you. What kind of trader are you? In fact, I was hoping if there was time, I would take you guys through an exercise to help you identify what kind of trader you are. So because depending on what kind of trader you are, then the time to trade matters. Okay? And the indicators to use matters. Now, for example, yes, I'm a night person, but my personality is such that I'm a high risk taker. I am not risk averse. Okay? I get bored very easily when markets go very slowly. I get bored very easily. I like to try new things. I'm one of those kids who used to play with spanners and open radios and open ads. I like to do things. So because of that, that's my personality. You find that the long time trades don't do anything for me. I like the short term trades. I like where the market is moving very fast. And so because of that, you find that I would prefer to trade like the 1 minute chart. Okay. Whereas the people who are more comfortable with 1 hour, the people who are more comfortable with daily charts, other than weekly charts, other than monthly charts. Okay. Now, for me, because of my personality, because of who I am, I like challenges. I drive very fast, so things like that. But then there are people who they keep at the speed limit. If there are cars, they slow down, then they slow down. Even if you can overtake, they don't overtake. They're very, very careful. You find people like those generally tend to be long time traders. They are not the short term traders. They don't have that adrenaline rush. They are very careful every time they take a step. It is a very careful step. So for them, the long term trades make more sense. Their long term is daily or weekly or monthly. For that, then the direct answer to your question is there is no best time. You can just go in the market like now. These are daily charts. Okay, each of those candles, these are called candles, takes 1 day to form. Okay, 1 day to form. So if you're a daily trader, and let's say we were here at that point, well, you wait and see. It starts going up. Okay, maybe you enter somewhere there because you're a long-term trader, a daily trader. Then you know that this candle is probably making a reversal. Okay, I'll try and avoid using some words you don't know. So this candle the market is going up. So the day trader, you might enter this and keep it for 2 days or 3 days. So day one, it's this first green one. Day two, it's that one. Day three, okay, and then when your profits are there, okay, because there you'll have moved from this point to somewhere there. Okay, so you'll decide, okay, 3 days later, I've actually made, wow, that's a lot of pips. This is 1.20060, and this is 1.21540. Made like 154 points, 154 pips, just by entering your trade and let it stay for 3 days. So you see, for you, because you're a day trader, it doesn't matter what time you enter the trade during the day. You can just enter the chart and say, oh, the daily chart is going up, so I'm going to do a buy. But do a buy, and then you relax. You say, I will check the trade 3 days from now. 3 days from now, you see it is up there, but now it's starting to play around like it's about to turn. Then you get out of your trade because you say, okay, the third day it's up there. The fourth day it seems to want to go down. The fifth day it's going up. The sixth day it's going down. Then you say, no, you know what? I'm done with that trade. You get out. You get out there. But it has given you profit from here. So that's 154 points. Okay? So for you, the day you are entering, you didn't have to say it has to be at 6 in the morning or 2 in the afternoon. No, no, no. You look at the chart, and because you're a day trader, you realize that the market now is going up, and so you entered. Now, if you are not a day trader and you're an hourly trader, again, that now depends on, again, your personality. If you're an hourly trader, you might decide, well, do I have time? 2, 3 hours? I must sit down and see if this thing's gonna go up. So I will, okay. So as an hourly trader, you might want to confirm if this thing is actually going up. So how do you confirm? Well, this it has reversed here and it has gone up to there. Okay? And maybe you missed the entry. You missed that entry. So you just want to confirm that actually it is going up. So how do you confirm it? Well, in the next 1 hour, when the new candle begins, okay? If it begins and it is bearish, it's going up, not going down, bearish going up, okay? When it closes, then you enter. You enter buy, which means going up, okay? So you are a 1 hour trader and maybe you're only targeting, maybe that's what, maybe 40 pips, okay? So that's a 1 hour trader. If you are crazy ones like some of us, you are a scalper and you're doing the 1 minute. So you look at this, it's going up. Okay, you look at this, it's coming down. So to me, I would look at my support and resistance. Oh, by the way, you can do the same using the 1 hour and the other timelines. So for me, I would look at this support and resistance because that's how I trade. At the turns of this. So as a scalper, this thing has come down and I realize that it's, maybe I've gotten data from here. Maybe it was going down, maybe there was like that. So then it went up like that. Okay. So for me, if I knew that was there was a resistance, a support there, a support over there, and there was a last support over there. As the market comes down here, I will start buying. That's for me. I will start buying. Why? Because my strategy is such that by the time it turns, I already have my buys ready. So as it starts going up, I'm just taking profit. And then I also know how far up the last time it was up. There and there. So as soon as I go there and almost reaching this resistance now, I start selling. Hopefully I'll have taken all my profit. okay, on the sell. I mean, on the buys. But now here, I start selling, 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 selling. When it gets there, then the market goes down, I just take my profit. Now, that's a bit awkward, more like a reverse kind of trading. Okay? But a normal person, what they would do, they would just wait until it reaches there, okay? And then they get into a buy. But remember, this is 1 minute. The 1 minute goes so fast that sometimes before you take the buy, the market has reached up and it's coming down again. That's why I try to be ahead of the game. All right. So now, if this is a low and this is a high, and it's coming down, you'd expect the market to come and revisit this low. If the market decides no, to revisit the low, it actually gets to a higher low. To me, it means it's on a trend. So this is a lower low, this is a higher low. It starts going up. Then I very quickly, as I was doing this, I'll be buying, buying, buying. When it is there, I'm in it. Okay. So again, this will tell me that by the time it gets there, I need to be going down. So I start selling from somewhere up there. Okay. So mine is a bit weird. That's scalping, but scalping means you are in and out of the market so many times a day, many times in a day. But as a scalper, I will not be shooting for the 40 pips or the 150 pips. All right. Now for me, I only go for 2 pips. Now you'll ask me, then how do you make money? Well, then I make like 20 trades or 40 trades. So at this point, if I do 40 trades between here and here, I've already made 40 times 2, which is 80 pips. Okay, just from here, from this point to that point, I've done 80 pips. Then from here to here, I do another maybe 80. So I'm doing my 160 pips just from that string, that move from there to there. Okay, and then from there to there, I do maybe another 70 pips. So that's 70 plus 80, that's 150. Then from there to there, I do another maybe 50 pips. That's like 220. So for me, instead of waiting for 1 or 3 days to get 154 pips, I can do that 154 in less than a day. But that's because my strategy is different. Right. Yes, the indicators, I don't have time to get them right now, but most of the indicators, some people, let me see. Okay, so I'll use like maybe a moving average. A moving average will go something like this. So these are simple moving averages. Now, a moving average basically gives you a heads up as to where you are and maybe where you can take your trade. Okay, so for example, those people who use indicators, you will find that with a combination of moving average and support and resistance, they can easily go in and out of the market. Let's give you an example. Okay, so if you're an indicators kind of person, every time the moving average touches maybe a support or resistance, it's time for you to enter. Every time it touches there, it's time for you to enter. Every time it touches, it's time for you to enter the market. Okay, time for you to enter. Moving average, sorry. So every time a moving average touches a support or resistance, it's time for you to enter. That strategy that yeah.
Yeah, I think I've understood. What I wanted to understand is, and I'm still having challenges with this, is when you take the relationship between the lots and then you want to relate that to your stop loss
Mm.
and where you're going to have your target for profits,
Mm.
and you want to make sure that you have a profit, or you want to have a risk to reward ratio that is acceptable.
Mm.
I'm really having challenges trying to conceptualize that.
Mm.
I don't know if you can take time and just explain this before we go to.
Okay. So what is the question? The question is what? The risk and reward
Ratio. Is there any concrete,
Mm.
A specific ratio that you should be having in mind, so that when you're setting your lots,
Okay.
you obviously know that you
Okay.
cannot go below this
Okay.
take a trade.
All right.
Yeah.
Now that's what we call, when you're a technical trader, you almost use that as your Bible. You need to find out. Technical traders tend to tell you that if, for example, the markets go up and down, and then up and then down, when you have what they call, like, they call it a double top. Okay, double top, something like this. So it was going up, and this up is just like, going up like this, like that, like that, like that, and then come down, and then up, and then come down, so up there. So because of that perception, okay, that is formed like a double top, then it is assumed that it will come down, assumed it will come down almost twice that distance. So from here to there, you multiply it by 2. So my pen is not what. Okay. So this distance, you multiply by 2. Okay, 1 and 2, up to somewhere there. So your risk, you must enter into this market here. Okay, you put your stop loss there, and you put your take profit somewhere down there. Okay, so if this is 1, then the ratio of that is 1 to 2. Now, you take the ratio 1 to 2 when you see something like that forming. When you see like that double top, okay, or triple top, then you know that as it breaks down to go downwards, it will go twice the amount of from there to there. It will take about twice. Now, that for that kind of a strategy, that's the kind of suggested take profit or ratio of your of your trade. Now, there are other patterns. Okay, there are other patterns like the one we were saying earlier. Okay, so okay, this one is about to break off. Okay, so now like that, you can't say it will be 1 to 2. It can't be 1 to 2. Okay, so to me, I would say that if it's going to go up, where is your next resistance? All right, chances are if it breaks out, it might end up as far as your next resistance. So you need to measure how many pips it is from there to there, okay, and then measure from there to there, and then you decide. If it's almost 1 to 1, then you try and take a trade, your profit, before it hits that resistance. All right. So, in other words, there's no magic stick that says if it's like that, it must be a 1 to 1. No, might not even work like that. There are times when it's not even, you don't even go up there. It will reach up to somewhere here, and then it will start going back. So that ratio, or what is suggested, to me, as a scalper, I always say it's neither here nor there. But for people who do long-term trades and look at the charts, a little longer, they would say, okay, fine. If this is the price, they call the price cycle for this trade, chances are it's going to do a similar price cycle up this way. So if I'm going to take a trade, then I want to take the same price cycle, maybe 1-to-1 or something like that. But if that's the case, you'll have to wait for a long time because this has only reached here. So you'll have to wait for a long time for it to get there. So I don't know if I've answered your question, but that's a question we can handle much later because the details we need to get there is a lot more than just what we've covered so far.
Okay, so yeah, I think it's okay.
Thank you.
Thanks.
All right. Ladies and gentlemen, I think if you allow me, let me get to the charts just a little bit, at least for the sake of the people who've been here long enough. So I'm going to switch now to another platform, but this time we will enter the trade. Let me see if I can do that. Okay. So I'm going to enter MT4 platform, but the web version. Okay, can you see that?
Yes.
Okay. So usually,
Yes, we can see that.
yeah, this market watch, for me, because I only trade one currency, I like to remove it. But for many of you guys, if you are still new, okay, there are many currencies you can trade. Okay, so for me, I normally do Euro USD. But others would like that. Okay, CAD. Okay, and sometimes you might want to look at them all on the same platform. Okay? But for me, I only like to do one currency at a time. But I prefer Euro USD. So for Euro USD, this is the kind of chart you'll see. Now for the new traders, the y-axis is the currency. Okay? And we start from where it was the lowest time, and as you look, it increases every day or every time or every minute, it doesn't matter. Yeah. Whereas the x-axis is time. Please note that this is a minute chart, so it's all happening the same day, the same time. So you can almost see the minutes, 27, 35, and so on and so on and so on. But if I was to share with you the other time frames, which I think I can now, what are the time frames? That's daily. Okay. This is weekly. So what does that mean? It means that it takes a week to form one of these candles. Those things you're seeing there, the chart. It takes 1 week to form one of those. All right. So if you look at the dates, the times, this goes back, in as low as okay, that's weekly. So weekly, so this is May 24th. Okay. So if you look, this is March, February, December 2019. Okay, so if you count 52 candles from here, 52, that's 52 weeks, you'll be 1 year after, I think somewhere around there. But this is April 2019. So these are weekly. Okay. Now if you change that to months, okay, then you'll find that okay, so that's month. So the months can go way back. This is 2016. So on a monthly basis. So this month, we can say the market has been on an uptrend. confirm that we still. So the market has been on an uptrend. Okay. So this is April. So this was May. Okay. This was February, March. February, March. So the last few months, Euro USD has been going up. All right. So if you are a long-term trader, you could have entered when it was very low there, and right now you would have done, I don't know how many pips. Let me see. You would have done from there to there. You would have done about
74.
74.
96.
Yeah, what 96?
77.
Yeah. Okay, I can't see very well, but anyway, that's the idea. So again, for the sake of those who are still new, I just wanted to show you this is the chart. Okay, and once we're in the chart, we have to figure out how to trade. So for me, I do the 1 minute trade, and this is the 1 minute. See, as you take the trades, you can see what's happening. All right. So what I would do typically, okay, when I'm doing my planning, I would look at the long, like the daily charts, because I'm a scalper. I come during the day, I look at the daily charts and see what's happening. I see during the day that the chart, the currency is going up. So, but I mark the charts. I put the last lows that they had, and every time the market turned, okay, I mark them. Every time the market turned, I mark them. So this is not a major one, but this one here is a major one, a major turn. Okay, so I kind of have an idea from a daily perspective. Then I go down to 1 hour. Now the 1 hour, as you can see, some of the marks have disappeared, but I do the same thing. I mark them where the market has turned, where it has turned. So once I've marked them on the 1 hour, then because I'm trading the 1 minute, okay, I go to the 5 minute, and there must be a confluence for me. There must be, by confluence I mean the market, the 1 hour and the 5 minute must be in the same direction for me to even consider a trade. And if that is the case, then I look for the 1 minute. Okay, so I go to the 5 minute and do the same thing. You know, mark my supports, resistance. So resistance is always the top, and support is always the bottom. Okay, just like a roof and the floor. The floor provides support. The roof provides resistance. Okay, so I mark them. Once I mark them, so that's why you see my charts are always kind of like messy, not messy, but full of marks. Okay, sorry, this is all right. So the 1 minute trade for me would mean that I know that maybe the 5 minutes is saying that it's going up because I've confirmed with the hourly. So in the 1 minute, I easily take the trades. I do like buy. But because I'm sure, right now it won't allow me because I've taken too many trades. So I have to kill this one. Okay, this is a demo account, so don't worry. I'm killing them with negative. All right. So now I see it's going up. If the market was going up, I then enter. This thing here for MT4, you can actually set it up. This is an automatic button that allows you to automate your trades. It's called a one-click. So for MT4, if you want to, the market is going up and you want to buy, you click on the buy. it's going down, you click on the sell. So for me, I would then, once I know the market is going up and I'm targeting, my focus is there and there. In between, as long as it's going in between, I want to buy. Okay. So I'm playing between the support and resistance. All right. So I would buy. When it reaches the top, I know that maybe if the market was going down, then I will not enter the trades because I know we have a bias of up. So I wait for another opportunity when it has reached there and it has come down again. So this time, even though it was at okay, it was low, I know that this time, if this was a low, okay, it goes up, it will come down again, but this time it will be a higher low. So at that point, I enter again. Then it goes up, then comes down. Okay? Then it's a higher low. Then I enter again. So you see, I'm only strategically entering when I am sure of the direction of where it's going. Okay. All right. Now, indicators. Here, there's no indicator. What I'm doing purely price action, which means I look at the candles, I look at the where they've reached, the price where it is, okay, and I make decisions based on the candles movement. That's what we call price action or naked forex. Because my argument, I think before I used to use indicators, but indicators are, for lack of a better word, okay, they're lagging. They're called lagging indicators. They only give you like this. Right now, you can say it's going up or going down. When it's done doing what it's doing, the numbers it has hit, the highest and the lowest, those numbers there that I'm showing, those numbers will then be taken into a calculator and calculated, and then you will see an indicator forming. Let me see if I can look at it. Indicators. So here they are. Let me see. Volume. So we are not doing all the indicators now, but I just want to show you moving average, stochastic. Okay. All right, the stochastics. These ones tell you when the market is oversold or undersold and so on and so on. So most people will, okay, most people will wait for this, for these things to go, these two lines, this line here and that line there. Okay, those are the two extremes. So when the market is down there, we are saying it is oversold. So because oversold, you want to enter and go up with it. When it reaches up here and goes beyond that line, we say the market is oversold, overbought, sorry. If it's overbought, then you want to enter and sell. Okay? And then you wait, you don't come out yet until here. So when it's here, it is oversold, and then you enter. Now, that sometimes, or most of the time, it's supposed to coincide with where the currencies are. So here you're going to buy. So ideally, you're supposed to be able to buy from there. Now, unfortunately, it's not 100% correct because, okay, this next point where this one goes will only be formed after this has happened, which means it's lagging. It only gives you a print after that has happened. All right. So that's why sometimes you'll find that it is wrong. Okay, let me, if I move this a little bit. Oops. Okay. All right, that's correct. So most of the time it's been correct here. Here, that's correct, correct, correct. So if you follow this indicator, for most of the time it's showing you correctly, but then there'll be times when it is not showing you anything, like here. Well, okay. Something here. So anyway, it has moved. This thing keeps moving. But see, what I'm trying to show you is sometimes what it's showing there is not what is happening there. Okay? And there are many, many instances where it gives you like a wrong indicator. Like now here it's telling you to sell. Well, here it shows that it's actually going very fast. But if you look here, it's barely moving. Barely moving. Again here, from here, actually from here, telling you to sell from here. And it's supposed to be moving a lot. Okay? So this, the indicator, there are people who like using the indicators, and yes, it helps. I'm not totally against it. I used to use them before until I discovered price action. Well, until I realized there's what we call price action. But for beginning, it is good to learn. You can learn by using the indicators. They can tell you, they can give you a heads up of what to do and where to do it. All right, I have to be cognizant of ETC. People can get tired, so I can make it open for questions a little bit. I know we didn't go too much detail on the trading, but that's because I spent so much time on the basics. So maybe next time we need to spend more time just on the trading. So next time I will.
Tom, just do 2 trades there where you are. We see what happens.
2 trades. Okay.
Yes.
All right. So
please.
this is 1 minute. Okay. All right. So I can do. I'm going to assume. See, it's up here. I'm going to assume that it's going to start going down, or it's still on an uptrend. If I was able to move this chart, there it is. Okay. So it seems to be going down. The market seems to be going down, or at least somewhere there. So I want to do a sell. All right. So I'll do a sell. Okay. I've clicked once. I've clicked twice. So if I'm doing that, then I would probably want to take profit when this reaches when it reaches here. Because I'm a scalper, I want it just to come down. When it gets there, then I take profit. All right. Now I've assumed it's actually coming down. So it's coming down a little bit. If I was to look at the trades, they should change from negative to positive. So now they're negative 16. If this indicator is correct and it's actually going to go down, then you'll see these numbers becoming smaller and smaller and smaller. Okay, they're already becoming smaller. I think they are minus 13. So they might come down, so now they're minus 9. Okay, they're minus 1. Okay, now my screen is very small. If I keep going down, you not see anything. Minus 5. As you can see that. Now, if you noticed, we took the trade somewhere there, but because of the spread, it jumped a little bit. So this is where we are. Okay, so I can keep sitting here and waiting for it to reach the profit. Now it says minus 5. Okay, it will be 0. And if it continues down, you'll see the indicator here going to that line. So, but I'm suspecting it will stop there. Yeah, it might hit there and bounce back. So if the time was maybe like during the London Open and so on, or New York Open, there would be a lot of movement. Hence, it probably would have reached here very quickly. But now it seems like that's the farthest it will reach. And because of the spread, we took the trade and we were already in deep negative. So we can't even take a profit. Why? Because of the strategy. I am a scalper and I only want 2 pips. And right now I can't get my 2 pips. If you look at where the market is moving, so from there, although we took the trade somewhere there, but from there to there, it is not 2 pips. Okay, it's actually 0.9, not even a pip. So that is the problem. The price cycle right now for my strategy is not good because the price cycle is less than a pip, less than 2 pips, and I need 2 pips to enter trade. Usually, so but you get the idea. You just click, 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 click. All right. So ideally,
Thanks,
now,
Tom. It's clear.
when you're down here, see it's now starting to go up, Then we're supposed to start buying. So the indicators tell you to buy. I've taken like almost 5 trips, 5 trades. Okay. So then as it goes up, again, once you pass, please note that where we took the trade is not where it started because of the spread. We took the trade here, but it indicates that we entered here. So we have to cover from here to there. So from here to there, we'll still be negative, negative, negative until we get there, we get 0, and then we'll be positive. So if you look at the last trades I took, they'll still be negative, the buys. The buys are these bottom ones. Okay, so you see, they're high negative 23, 22, and so on. If the market continues to go up, this negative will get less and less and less until they get to 0. And if it goes up and up and up, then it becomes 1, 2, 3, and so on and so on and so on. So for a scalper, this is not the best time to trade. Why? Because there's not enough volatility to trade the 1 minute. Okay? If you went to like 15 minutes, that's a different story. 15 minutes or 30 minutes, okay? Because now there's a bit of number of pips from one low to the next, from support resistance, a bit of number of pips. So I've taken 2 trades. They are still negative right now, but don't give up some of these things. If it's going to be up and down, I've taken both buy and sell. Eventually, some of them will start being positive. But when we start doing the strategies, then we'll focus 100% on the strategies. We'll not spend so much time on the basics, on the ABCs, which is what we were doing. Hence, we don't have time to work on the trade the way we were hoping. Any other questions?
I have a question. I'm Dennis Otieno from Kenya.
Yes, Dennis.
You are using an MT4 platform, isn't it?
Yes, the web version.
Okay. Because I'm wondering, in the version I'm using, I don't have this part that you have in the top left corner where you can just click and then it takes a buy, click and it takes a sell.
It is
Yes.
there. It is there. It is, depending on the broker you have, the broker may have deactivated it. Okay?
Okay.
The broker may have deactivated it. But usually if you click on somewhere up there, it would appear or disappear. Or, yeah, for this one, it comes by default.
Yes.
Yeah. But either it's your broker or if you click somewhere up there on the left, it should,
Yes.
little black thing. And then if you click on it, it's a one-click trade. You have to activate it. So in one of the videos, in one of the short videos I sent you, please look at that. Sawa.
I'll be looking for it.
Okay, thank you. Okay, can I have maybe last two more questions?
Yeah, William Olega from Zambia again.
Yes, William.
Yes, I've been seeing the strategy that you're using. Like, if before entering the sell,
Uh-huh.
you start when you anticipate the price is going to go down.
Mhm.
You start buying whilst the trend is still going upwards.
Yes, yes.
So, since you said you're a scalper, okay, can someone use the same strategy like for if you're trading for 1 hour, or for maybe a day trader? Can still one use that same strategy, or it only works with a scalping when you're doing scalping?
Actually, it works with all currencies, but you have to know what you're doing. It works with all currencies. I mean, all time frames. So the only thing is, on the bigger or longer time frame, it's kind of awkward. It's awkward that you're in a 1 hour time frame, the market is going up, but you are selling. Okay, because then it will look awkward. However, if the trend is downwards, if the trend of the market is downwards, then you have a legitimate reason to actually do that strategy. Let me see. Okay. The only thing is, I'm trying to. So let me look at this. So, okay, let me, for lack of, I'll use this chart we have here. Okay, if it's a 1 hour chart, okay, and you know that the market is going to go, like now it's just consolidating up and down, up and down. So it's going up and down. So to me, if I was to trade this consolidation, every time the chart starts going down, when I'm halfway midstream, as it's going down, I start buying. Okay, I start buying. And the same thing when it's going up, when it's halfway through, I start selling. Okay, so like here, if the market is going from there, it's going down, and then it's going up, and then it's going down, and then it's going up, and then it's going down. I don't know. So if it's a 1 hour, then yes, at this point, okay, when it's turning, if I just came in right now and I didn't know all this, then I would start going with it. I'll start going down with it. Okay. But when I reach here, I have to be careful because I don't know what's going to happen. So hopefully I'll have taken the profit, but then I wait. Once I confirm it's going down, I start buying until it turns. When it turns, then I wait, let it ride. You can still do that on the 1 hour or other time frame, but it will just be awkward that you are buying when the market is going down. In scalping, the 1 minute, because the market is moving so fast, it's okay. Because if it's going down, you know it's about to come up. If it's going up, you know it's about to come down. But for the 1 hour, it will be a little awkward for that. So psychologically, you might even not even do it because you feel like, why are you willingly, knowingly going against the trade, going against the trend? And they say the trend is your friend. Yeah. So I think, ladies and gentlemen, it's 9:30 Zambian time, as they call it, what, 21:30, and in Kenya,
21. Yeah.
in Kenya it is 22:30. Well, 10:30. So I
Okay.
I have to be considerate that the people who have to sleep and have to wake up and have other responsibilities. I am a night person. I can still keep going on, but I will not do that. So you can keep the rest of your questions and ask them in the platform. So what I will do, because today I've spent so much time with the basics, next time we'll get more into trading. So I always find myself lagging behind. But then again, see, in our platform, we have people who keep coming as late as today. All right. So we have to bear with them. Eventually, I will split the classes so that we can have or I can bring them up to speed so we can have more trading time than learning of the basics. Okay. So having said that, keep checking the platform. I think I'll have something on Thursday, but this time more trading. Then you can have more questions. I challenge you to read and practice, so that it can make our classes more interactive. Right now, it doesn't make sense even for me to ask you questions because I don't know where you are in terms of your level of understanding. But hopefully, with time, we'll have taken care of the ABCs and focus more on trading. So I have a recording and I think I will stop it now so that whoever comes, they can at least look at what they did not see before. Okay. So is it okay if we call the night?
Yeah, that is true.
Okay. We can
Thursday.
we can continue discussion in the platform. Okay. And invite your other people, friends, because this is free. Other people will charge you a lot of money to do this. Okay. But for me, I told myself, no, I want my people to learn for free in a safe environment without being asked for money. That's my intent.
We appreciate